Hello and welcome to Rush Hour. I'm Ankur Mishra. Let's get started with the news which is related to economy. Yes, Fitch has upgraded India's FY26 growth outlook to 6.9% versus a forecast of 6.5% earlier on the back of strong domestic demand outlook. Fitch has also cited GST reforms as a key trigger behind the upgrade, as it expects the rate rationalization move to boost consumer spending over the remainder of current fiscal and next fiscal years. To discuss about this forecast, we have with us Alex Muscatelli, Director Economics Fitch Ratings from London. Alex, welcome to ET Now. My first question to you is, Fitch revised its economic India's forecast in FY26. What's the pace Fitch now expects India's economy growing this fiscal year?
Yes, so we published our new global economic outlook just yesterday evening, UK time, and there we revised up India's GDP forecast for the current financial year to 6.9%. From 6.5 previously. Now, the key driver of this upward revision was the very strong outturn that we saw in the first quarter of the financial year, with GDP growth accelerating from 7.4 to 7.8%. And also, just looking at the components of growth, the composition of growth gives us a bit more confidence that it will be sustained in the near term. Including also the outturns from other indicators, for example, business surveys looking into the summer. So that was really the main driver of our upward revision. So now we are expecting 6.9% for 25-26. But we do still see a slight slowdown in growth for the following two financial years to 6.3 and 6.2% respectively, as the Indian economy slows down, considering that it is currently operating above trend, and there will be some and so there is some limit to the speed at which it can grow over the years ahead.
Right, point taken, Alex. But how much headroom does the headline inflation provide RBI to further cut the benchmark rates?
Absolutely. I think there is still now. I think we have been slightly surprised by the pace at which the RBI has cut. This year, we've had 100 basis points in the calendar year, but we still think that the combination of low price pressures and some uncertainty over activity in the more medium term allows the space for the RBI to cut once more, and we think they will cut once more in the current calendar year, so before December 2025, and also because with the current low inflation, they will want to avoid real interest rates drifting up too much. So we think there is scope for one cut, and then we think rates will stay at 5.25 until and this will be the trough of the easing cycle, and while in 2027, calendar year 2027, we expect the RBI to start raising rates again, as the economy will still be above trend, and price pressures will be increasing by that point.
Alex, one more talking point in India has been private investment. So do you see a rebound in private investment in India, and what will be the drivers for the same?
Well, we see some signs of a revival. When we look at the softer data and soft indicators, As I mentioned earlier, the RBI has cut rates quite a bit already this year by 100 basis points. I think some of that should feed through to stronger spending and to stronger capital spending. A lot of the work has been done by the public sector in the area of investment, mitigating the risk that this may not happen is also related to the international situation, the uncertainty of US trade policy, and the impact that could have on business sentiment. And so that's the downside risk that we see. But we do think that there will be some recovery in investment.
Alex, the tariff threat still remains while India and US both have now stated that the talks are going on. But what impact do you see US tariffs will have on India's economic growth momentum?
I think there are two aspects that derive from this, that are related to this. One, what would the direct hit to the Indian economy be from higher tariff to levels seen for other countries? But we think that if tariffs were to remain 25% higher than before, then that would shave between 0.3 percentage points of the GDP growth rate of India. Now, this is not such a great, especially in the context of an economy that's growing between 6 and 6.5%. It's not that much. There is the risk that that it's not just a direct effect that could hit the Indian economy, but also the indirect impact through uncertainty and through business confidence. The other part of your question was how it would affect also other markets. Well, I think that a large part there is the extent to which the differential in tariff levels between India and other trading partners is high. If, for example, the difference between China's very high tariff rates and India's were quite high, then we could see some trade diversions. We could see some boost to exports for India from there. But it really depends on where things settle down here.
So, Alex, what will be economic tailwinds for India to improve its international sovereign rating?
Well, as you mentioned, we actually affirmed the rating very recently, just at the end of August. Even though we did not, obviously, in the context of slightly lower growth forecasts, but the stable outlook in and of itself tells you the rating is unlikely to change over the near future. But in terms of where the strengths and weaknesses lie, then I think the confidence in India's growth prospects that can bring about and structurally sustainable growth that can bring about a decline in debt ratios and also fiscal policy credibility and fiscal policy settings that improve fiscal metrics compared to its peers would be another area which could eventually lead to positive rating action.
Alex, one more announcement which has happened in India is GST rate rationalization. How much of the impact do you see on the economy due to that?
Yes, we have factored that in to some extent to our new forecasts. It's a bit difficult to do this and to gauge precisely how positive the impact will be, because it depends a lot on how firms react to the tax changes, and whether the tax cuts are passed through to consumers through lower prices. Now, we think that to some extent they will, and we think that it will boost growth. It will, other thing, compared to counterfactual of no reform, by a few decimal points, both for this financial year and next. In terms of fiscals, we think that the fiscal cost of this will be relatively limited, of around 0.2% of GDP.
Overall, our finance minister did state that the impact on the fiscal position of India, if at all, will be around 48,000 crore due to GST. What is your assessment of overall India's debt position? Do you think there are concerns?
Well, two quite different stories there, but external finances are not a particular worry. In a sense, it's a relative strength of India's rating, while fiscal metrics are a relative weakness.
So considering the announcements made on GST, considering how we have moved forward in the economic front, what will be the fiscal gap in FY26 according to you?
Well, in and of itself, the goods and services reforms will raise the deficit. Now, where we see the deficit going forward, at the time of the review of the rating review that we talked about earlier, we forecast the general government deficit to narrow to 7.3% of GDP in financial year 26 and 7% by financial year 28. Now, as I mentioned earlier, the rating review was published and was finalized before we updated our forecasts. So we will revise and review these fiscal projections in due course over the next few weeks. I don't think they will be very different, but the stronger growth dynamics in the short term should translate to a lower deficit, other things equal.
All right, Alex, thank you so much for joining at this hour with your views, and we'll keep an eye how actually India's economic position evolves. But it's time